Hello and welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Keith Weiner, the CEO and founder of Monetary Metals. Keith, how are you doing today?
Doing good, doing good. Thanks, Robert.
Really great to have you here. A couple of things we wanted to go over. The nooks and crannies of this particular podcast. We're going to look into gold leasing and gold bonds, and we're going to talk a lot about monetary metals there. But before we do that, probably a good idea to just go over current gold and silver markets. And I say that because I see a lot online, and everyone's got their own different thoughts and opinions and forecasts and so forth. Uh, what have you seen so far in 2025? Business as usual, or it's something else occurring you think's a concern?
There's something very unusual going on at the moment that if you read online, of course, everything that happens is always bullish. You know, demand is dropping, that's bullish. Demand is rising, that's bullish. Demand is stagnating, that's bullish. Um, there's a little known outside of the professional trade, a little known corner of the gold world called exchange for physical, EFP, where professional dealers and market makers um, will be able to trade if you have a futures contract that's coming up but not yet mature. So let's say right now you have a February contract. Actually, no, that's not a good example because February would already be just about first notice day. But uh, let's say you have a March silver contract. You can say, okay, I want to get the physical metal this contract represents. I want to swap it to somebody who will give me that bar right now, and I'll give them the contract in exchange, which in theory is a neutral transaction, right? So contract is 5,000 ounces of silver. Someone's giving you five 1,000 ounce bars. You're even, but there's a spread between the physical and the futures contract, and that's the EFP premium. You're going to pay somebody for the service. Now, normally physical means unallocated gold in or unallocated silver in London. Um, but in the US, the dealers that make a market in this will base, if you want the physical bar in New York or in the Delaware Depository, for example, um, they'll base the price of that swap on the EFP, and then there might be a separate product premium or discount. um, but it's basically the EFP. So what's happened in the wake of Trump saying that he would potentially impose, and nobody really knows what's going to happen at the moment, and I always have to be careful to spell out, I don't try to make political predictions. When I make predictions about the monetary system or about the price of gold or something like that, there's a science to it, and it's not based on what the next politician may or may not do. It's very political. You have a president, you have all of his advisors that may have different opinions. You have the Fed, which is definitely not 100% under his command. You have the Congress, and even the Republicans are not 100%. It's like all these moving parts. And so it's like you have a tractor trailer, but you have like five or six trailers behind this thing, and each one has a hinge. And you're trying to predict where this thing is going to go. Well, that is a whole other thing. So, anyways, he's potentially, maybe, possibly going to impose 25% tariff on all imported stuff. And so, if that includes gold and silver, I think that would be an unmitigated disaster. I think that would be terrible. And I can talk about the consequences of that. But at the moment, that potentially leaves market makers and dealers with a giant exposure that they didn't know they had.
Mhm.
And so there's a recent analog to this, which is COVID, and the normal trade, leaving aside EFP, and I've been writing about this, for at least 14, 15 years, is the carry, where somebody will buy physical, which is London generally, sell future, which is New York, and there's an arbitrage. There's a spread between the two. So if you can, conceptually, you think you're buying gold for 2,700, you're selling it, let's say a month in the future for 2,720. There's a $20 spread per ounce. You're not betting on price. You're simply pocketing a spread, and that's fine. And that trade goes on, all the time. as long as the spread is positive anyway. And then COVID happens, and suddenly all the airplanes are grounded. And gold normally travels in the belly of airplanes. It's too valuable to ship on ships,
Mhm.
which were also, grounded at that time in March and April of 2020. And gold normally goes, or very often goes anyway. Not on you don't fly a dedicated plane. You stick it in a commercial airline in the baggage, and Brinks has a relationship and there's a secure thing that brings it in, and it's dealt with and it's accounted for and checked and audited and whatever. That don't generally lose it. There was a thing with Canadian Airlines last year, a couple 3 years ago, where they lost 30 million worth of gold. It was such an unusual event. It made the news everywhere. Normally this is reliable, it's fine, obviously it's insured anyway, but so COVID, suddenly you can't ship the gold anymore. So now imagine you put on this trade where you buy it in London, you sell it in New York, you have to deliver it in New York. Okay, you got the gold, but now you own the gold in London and you can't get it to New York anymore.
Mhm.
Which, from the perspective of March 6, 2020, to say, well, what if you can't get it to New York? Everyone said, what the hell are you talking about? What are you smoking? But as of March 13, 2020, everything was locked down. And suddenly that was a reality that nobody, it was, as the joke says, that wasn't on my bingo card for this year. So anyways, with the tariffs, you kind of have a similar situation that gold may not be, you can bring it into the country, but it may not be economically viable. I mean, the spreads that you're pocketing on this carry are pretty small. I mean, 20 might be, the large end of it. Um, and 20 would be almost, two-thirds of 1%. These things are normally, 10, 20, 30 basis points. So all of a sudden to have a 25% tariff, what does that amount to in dollar terms? Almost $700, which is completely, bankrupt anybody that had put this trade on in any kind of size. So all of a sudden, everybody is trying to exercise EFP and do anything else they can to get the physical bars that they anticipate they might need to deliver. And so all of a sudden, there's a big flow of bars from London until the tariff slams down. If you can get in before the window closes, you're fine. So big inventory accumulation in New York, big inventory moves out of London. The EFP spread is blown out. It got much, much, much more expensive, just as various spreads blew out during COVID. This one blew out, and everybody's writing about this as if this is a harbinger to much higher gold prices. Sorry, guys, not a harbinger of higher gold prices. It's a harbinger of wider spreads, which means less coordination in the market, less efficiency, and that spread is going to be reflected at dealers. When you go to buy an Eagle or a Maple or a Krugerrand at a dealer, normally if you want to buy, they're saying it's 27.50, and if you want to sell back to them, they're saying it's 26.50. Well, the worse the market gets, they have to widen that spread. So if you want to buy from us, it's 2,900. You want to sell back to us, it's 2,400. They're
Mhm.
going to have to widen because their costs of hedging and everything else are just going up. As the spread becomes both wider and more volatile, you get less liquidity, much more friction, you know, bigger frictional losses to traders. And if you buy that coin and then you have to sell it back next week, bigger losses. And um, and of course, the professionals are going to start to say, well, we need another futures market that isn't New York because with 25% tariff, the whole thing's a non-starter. The U.S. becomes like a third world jurisdiction that's impossible to deal with, and very frictional and very bureaucratic. Like India. I mean, nobody would ever locate a futures market in India other than internal for Indian use, but it would never be a global market for that reason. So they're going to start to think of Toronto, maybe Dubai, but someone else is getting an opportunity to have a market, and then all the dealers will move there because the New York market just suddenly became unviable. So I hope they don't do the tariffs, but that's what's going on at the moment. Um, what I always say is, if you look at the price action, a lot of people try to divine as in like a divining rod, magically determine what last week's price action is going to somehow predict next week's the price action. And I'm not really a big fan of that. Yeah, there are chart patterns and sometimes they're fulfilled, but sometimes they're not. But if you look at and the prices are always volatile and always moving all over the place.
Mhm.
But if you look at a spread and you see a spread that's pretty consistent and doesn't really move that much, and then suddenly, boom, it blows out by like 800%. That is telling you something.
Mhm.
And you may not necessarily know what it's telling you. That may require a lot more study and a lot more research, but it's telling you something. And sometimes that spread is telling you it is a harbinger of price movement. And we talk all the time about the gold basis, that spread between future and spot. And that moves, yeah, that is predicting what can happen with the price. But this particular EFP blowout is not really predicting about price. It's predicting about the possibility of tariffs, and everyone's trying to avoid being bankrupted by bringing in as much gold or getting their hands even on domestic gold so that they can deliver into that contract that they've arbitraged. And even if they lose a little bit of money paying that EFP spread, that's way better than the 25% tariff that they potentially might face tomorrow or next week.
That makes a lot of sense. And I was reading an article this morning from I forget which paper it was over in the UK, and apparently they were saying that the Bank of England is I quote in trouble because they have now started saying that if for delivery purposes it's now between 4 to 8 weeks for delivery. It's something along those lines, whereas the time scale is quite short at the moment. So what you said, in my mind, goes hand in hand with what I was reading this morning. And as you said, that can have massive implications moving forward. If tariffs come in, then chances are it's going to have a negative effect on the markets. If tariffs don't come in, then it's fair to say we're probably in a bull market. Obviously, a lot of currency printing and so forth happening. So the trend is up. So from what I'm understanding is although there's different elements in play at the moment with the tractor and the 5 or 6 trailers in the back, are you saying that a lot of what could happen moving forwards really is down to these tariffs, whether or whether or not they get implemented?
Well, specifically with regard to the gold market for the professional and institutional players, yeah, the tariffs are a really big deal. Now, I think one way or the other, this gets resolved, and either they're going to have the tariffs, in which case the market's going to go screwy in terms of volatility, and eventually, either get an exemption. Right. So the last time that Trump did tariffs in 2017 or thereabouts, I read there was something like 57,000 applications for exemptions. Right. So people say, clean the swamp, but it got pretty swampy around all that, and because everybody wants to be exempted. And they're like, no, no, no. The national interest doesn't depend on tariffing me. And yeah, you're going to tariff everybody else, and all these other things have to be protected. But my business, please make a carve out. And so then you get carve outs based on political patronage and how much did you donate, and all the other stuff that we don't like to think about too much about the corruption of our political process. Assuming they don't get a carve out, then the gold market's going to have to carve the U.S. out, at least for purpose of a main clearing market. Assuming there isn't tariffs, now it's hard to imagine that there's any, even if you're an economic nationalist, it's hard to imagine there's any case to be made why gold and silver, which are not consumer goods, and they just endlessly circulate anyway. I mean, the vast majority of all gold ever mined in thousands of years of human history is still in human hands. And, it trades, and every day it moves around, it sloshes from here to there. To say that we're going to create a significant barrier to bringing it into the US just doesn't seem to serve any interest, really. I mean, even if you think that you're saving GM by tariffing Chinese cars, who are you saving by tariffing gold? I mean, there's not even a nationalist argument for it. So hopefully they would just carve it out, even if there are tariffs. But either way, that's going to be resolved. There's not going to be an endless flow of gold into these arbitrages, or to let market makers out of the arbitrages. That's a temporary sort of one-off unique event, as COVID was. And
Mhm.
even during the height of lockdown and masks and whatever, there were enough planes restarted that spread was quickly arbitraged and didn't recur, like that.
Keith, before we get onto the subject of gold leasing and gold bonds, which is what we said at the start, the nooks and crannies. Obviously, we've just spoken about tariffs. Are there any other things in the gold and silver markets apart from tariffs that you think might have a bearing moving forward? Again, rate cuts or loads of inflationary spending. Is there anything else on your radar that you keep an eye out for when looking at the markets?
Most of that stuff. I mean, my favorite now is when people say, you know, something has to happen in the currency markets or something has to happen in the gold market because look at the U.S. debt growing exponentially. And I have to say, with sort of biting my lip a little bit, you could make the argument that, well, for whatever you wanted to say was supposed to occur as growth of debt was exponential. That's been true. Growth, debt has been growing exponentially since 1971. So at any given time, I mean, we can point to the debt now that they had in post 2008, 2009 level of debt and the deficit, right? It hit $1 trillion. And it's quaint. So, $1 trillion deficit, that's cute. That's nothing. I mean, but at the time, it was like, oh my God, right? And, a couple of years before that, people were talking about the Bush deficits of 400 billion. Oh my God, this is insane. It's going to destroy the dollar and the world economy and everything else. Because 400 billion was insane at the time. And of course, even by the standard of 2009, oh, 400 billion, you thought that was bad? That's cute. But at the time, of the $400 billion Bush deficit, you could look back at his father's deficit of whatever that was, I presume 100 billion or something. Oh my God, at that time, that seemed crazy. And the Reagan deficits, I remember everybody, I was pretty young at the time Reagan was in office, but everybody was going crazy about how insane those deficits were. And before that, Carter, and and on and on. So I don't think that really is going to matter that much. I think when interest rates fall, and I use the word when, not if, when interest rates fall, and by the way, there's a decision today, and I have not been in the news cycle. I've been in meetings all day here in Dubai, so I might look like an idiot that the decision was already announced and they're cutting rates or whatever. I just don't know it yet. So maybe you can helpfully tell me if that decision was announced or not.
Yeah,
Uh,
Keith, I'll jump in there. So what I will do is I'll date stamp this. So we're recording this 29th of January. We're doing this before the Fed announcement. So today the Bank of Canada, I believe, has decreased by 25 basis points. The Fed is expected to pause. However, this podcast is out on the 30th. So let's work on the assumption that the Fed does pause. But yeah, you are right. Given where we are,
so,
we might look a
you
bit
know,
idiotic if they change their mind.
when they cut, um, and there's also that political wild card that Trump has already said he's going to force them to cut. Powell has already said, I don't care what pressure, Trump can't force me to cut, which could be famous last words for
Hmm.
somebody that answers to the president, um, about all that. So I don't know how that's going to play out, but if they do cut, I think that is going to spur buying of gold, um, as it always does. But longer term, not so much. We've done graphs over the years. We have an annual, which is going to be coming out next month in February. We have our annual gold market outlook report, and we always like to put in interesting graphs. And a couple of years, we've looked at a graph of the gold price against nominal, what are called nominal interest rates, a graph of the gold price against real interest rates, so-called. Looked at the Fed funds rate versus 10-year treasuries versus TIPS, Treasury and inflation protected securities, and all these different things. And there is not really a good correlation of gold with any of these things. It's commonly believed, and so it'll trade that way, right? When the Fed makes the announcement to cut 50 basis points or whatever, boom, you'll see a big green plus 1 point something percent for gold and plus 5% for silver, right? But those moves aren't really I mean, okay, you can get a big momentum rally going, perhaps, but those moves aren't really durable because that's not really the driver for 8 billion people in the gold market. And gold is a global market. We tend to think it's New York and London, but those markets are really only the spearhead. They're, the bulk of the buying is in, China and Turkey, Arab world, India. Oh
Hmm.
my God, India, um, and other places where, let's face it, Americans have never had a real currency crisis. And the closest we ever got, let's call it 1979, where the annual inflation rate was 13%, if I recall. Now, a lot of people are going to quibble and say, look, Shadow Stat says it's whatever, which is a higher number. But, other countries routinely have that, 13% per month, not per annum. So they'd say, oh, 13%, was that per year? Oh, that's cute. You think that was, yeah, that's cute. Um, so Americans think of gold as something that, when it's hot and it's going up, it's just good speculation to make more dollars. But they're really thinking of it as a vehicle to make more dollars. The rest of the world, their currencies are toilet paper in many cases, and they know it. And it's not like you buy, in India, you buy gold so it'll go up and you sell it for a profit in rupees. They realize the rupee is always going down. Gold is savings, the rupee is not. Rupee is for retail purchases. Places like Vietnam and so elsewhere in Southeast Asia, when you buy a house, they're paying gold. They're not paying worthless paper currencies, for it. In some cases, not all cases. So, it's a global market, and they're not necessarily paying attention to or even aware of whatever Jay Powell just said, on the TV.
Mm.
And they don't care. I mean, their drivers are based on their own internals, and they don't trust their governments. They don't trust their currencies. There's a lot of shit they don't trust, and for good reason, right? Because it's been abused. Currencies have collapsed.
Mm.
Lop off three, four, five zeros from the currency, reissue it. These are regular, recurrent, sort of normal monetary policy in these places.
Yeah, I've always said that the difference in mentality between the East and the West is, profound. I always say that the East is playing a game of chess, playing the long-term game with regards to a lot of things in life, and the West. You obviously mentioned the USA there. I could definitely vouch a similar sentiment in the United Kingdom as well, where people are not really paying attention to what is going on. I find that fascinating. Yeah, also, just a side note, reminds me years ago when I went to Vietnam, and the exchange rate was 33,000 dong to a pound. That always made me laugh. Putting my card into an ATM and oh, I'm a billionaire. Then realizing it's in dong. Obviously, a bit different. But all of that aside, Keith, I mentioned at the start about gold bonding and gold leasing. So I'm going to sit back and ask some what I'm going to say very basic questions here. So I'm not going to claim to be an expert in this, but obviously yourself, Monetary Metals, have got a wealth of experience in this. So there's going to be a lot of people out there. Most people are going to be listening to this podcast who I would imagine own some form of bullion, whether it's gold, silver, or both. But most people, I would guess, probably do not know that gold leasing and gold bonding actually exist. So, what is it and how does it work?
So gold bonds did not exist until or at least did not exist in recent decades until we created it. So our first gold bond was 2020, and we announced that was the first gold bond since 1933, when Roosevelt broke the gold standard. And in the rest of the world, Europe was, in the interwar period, had by varying degrees already broken their gold standards anyway. But 1933 was when the U.S. really just took down the hammer and just smashed it. So we, issued the first gold bond, at least in America, but pretty much globally, since the 1930s. So gold leasing, there is a gold lease rate in the institutional gold market. That's not what we're talking about. That's essentially an arbitrage. Borrow at LIBOR and buy gold. So there's a lease rate that's imputed from that. But in the real world, there are real businesses that have gold as inventory or work in progress, and that has to be financed. I mean, if it was copper is $4 a pound. Okay, you need a few thousand pounds of copper, whatever, right? You're making plumbing or you're making whatever you're making out of copper. But gold, $2,700 an ounce, it doesn't take very much inventory, but suddenly you're talking millions of dollars. And the conventional means of financing it is you borrow dollars. So let's say you have $1 million worth of inventory. So to put that in perspective, that's less than 400 ounces of gold. Now, gold is so dense, if anybody hasn't held a piece of, 24 karat gold, it is much, 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 much heavier than it has
Mm,
any right to be for something that small. Probably one of the reasons why people were so excited about adopting it as money. It feels real. And even lead or iron, I mean, other things that you think of as pretty heavy, feel light and therefore sort of cheap and not the real thing by comparison. It's really, really, really heavy. So 400 ounces, I mean, mobile phone of this size, would be easily, this is like a large format phone. This would probably be 2 kilos
mhm.
if this was, 24 karat gold. So it wouldn't take very many of those, right? So 400 ounces, 12 and a half kilos, call it six of the large format Samsung Galaxy Notes, six of them, something like that would be 400 ounces. Nothing in terms of volume, right? So if you're a decent size jewelry store, let alone jewelry manufacturing, facility, it could easily have 400 ounces, probably a lot more than that. So you borrow $1 million, you buy $1 million worth of gold, and then the gold price drops 10%, which even in a bull market it could do. And then, of course, there's always the risk that the bull market you thought was going to go forever ended and reverses. And now you have a $900,000 asset, but you still owe $1 million. There's a technical term for that state when assets are less than liabilities. It tends to be called insolvency. And banks, in particular, tend to get pretty upset about insolvent borrowers, and they tend to take fairly drastic measures, like foreclose on your, what. And if this is a small business, you probably personally co-sign that. So now you have the bank not only, absolutely wiping out your business, but now all of a sudden they're foreclosing on your house and taking your cars, and you tend not to want to be bankrupt if you can avoid it. And so, okay, well, how do you deal with that? Well, there's that breezy Jedi hand wave. Well, you just hedge. And they say just, like, think of, Ben Kenobi, saying that that's not the hedging you're looking for. You, you know, um, so which means you're going to borrow $1.25 million to buy $1 million worth of jewelry. You put $250,000 in a brokerage account trading, futures in Chicago, or maybe contracts for difference or something like that, with leverage. And what could possibly go wrong, if you're shorting, gold futures with leverage? And well, the answer is a lot of things can go wrong. And if you're hiring an employee to do it, you have the appropriate supervision, monitoring, internal controls. Every once in a while, like Deutsche Bank announces, oh yeah, trader went rogue. We lost $1 billion before we shut him down. Um, and you think about the bank grade internal controls versus uh, what a jewelry manufacturer, which is a mom and pop business very often with um, uh, 40 or 50 essentially blue collar tradespeople. They don't have the financial sophistication to do all this. So leasing is a finance solution where, and monetary metals didn't create this. This certainly existed. There's an innovation that we did, which I'll talk about in a minute. But instead of borrowing, currency to finance that inventory, they lease the metal, which means now they don't own the metal. It's not on their balance sheet. And if the price drops, not their problem. So they get the finance they needed without the price exposure, which they don't want and don't need.
Mm.
It's great. It's a perfect solution. What Monster Metals has done is said, okay, let's do this as a platform where this is now open to retail investors, who own gold. And so, what is the conventional solution for owning gold? Well, you buy it and you have it stored in a professional vault, where at least you have insurance. Um, but now you're paying 3/4 of a percentage point per year in fees, and that gets old. I mean, if you think gold's going to go up 20% a year, you may not care that much about it. But when gold stalls and you have years that are sideways or whatever, those fees get tiresome after a while. So what we're doing is we're bringing two parties together. We're bringing the people that have the gold, saying, I want a smarter answer. It's better to get paid 3% than to pay 0.75% for storage. And for these guys, they have inventory or work in progress. So for a retail jeweler, they have all this inventory. For a gold manufacturer, or jewelry manufacturer, it's work in progress. So every day they're buying raw material in the form of gold bars, but it could be, what they call grain or shot, which is easier to cast if you're making small little delicate things. You melt a little, you pour out the number of pellets you need and you melt it into the mold. Um, but every day they're buying some raw materials. Every day they're selling some finished goods. And but there's always X amount, and it's typically thousands of ounces that are in the works. Like think of an oil pipeline. You're
Hmm.
always flowing more oil in. There's oil always flowing out, but the pipe always contains a certain volume of oil, which is a function of math, right? It's the length of the pipe times the radius squared times pi will tell you how much oil is contained. It doesn't matter how fast it's flowing. That's how much oil is locked up in your pipe at all times.
Hmm.
Now, again, oil's not that expensive. I don't know how the pipeline operators finance that, or if they need to finance it, or if they just absorb that as a cost of doing business. Gold is so expensive that, nobody operates that way. So we provide these leases that, we're taking, clients that have gold, putting a number of clients together because the amount that the lessee wants is a lot more usually than any one client wants to put up. The client retains the ownership. The client retains the exposure to the gold price. Um, there's monitoring and auditing and insurance and all kinds of things to protect. I mean, never say zero risk. Anybody that promises you a return without risk, run. That person is not being straight with you. But it's the lowest risk thing that we can think of to do that generates a return. And we're generating that return by doing something productive. It's
Hmm.
not like the crypto, markets where it's all internal and self-referential, and you have a little system, and it's supposed to be a perpetual motion machine, and and those things never work in the end. But they're real businesses, and there's about a dozen different verticals, right? So you have refiners, you have mints, you have jewelry manufacturers, jewelry retailers, some cases jewelry distributors or wholesalers. You've got recyclers, you've got high tech, like sort of coatings, you know, like have you ever seen mirrored sunglasses that have a gold coating on it? That's done with a high tech process called sputtering. Low tech, electroplating. There's a whole bunch of industries where they need more gold than you would think by dollar value, and at least just makes sense. And we do this with silver as well. Then there's the bonds. So a bond is not for a company that has gold inventory. It's for a company that has gold income. So they're producing gold, they're generating gold income somehow. And so the obvious case to think about is a mining company,
Hmm.
right? So they have the same problem if they borrow dollars and the gold price drops, they can be in trouble. They know how many ounces they're going to produce, but they don't know what the dollar value of those ounces are going to be. If they borrow gold, then the asset matches the liability. They don't need to hedge. Things become simpler, less moving parts, less complexity, less risk, less cost, less compliance. Um, and and they amortize. So the lease, they just make the lease payments to service the lease. At the end, they owe the return back of the 1,000 ounces. In the case of the bond, it's amortized, right? It's like if you want to buy a house, you borrow and take out a mortgage. Well, at the end of the day, you need to keep paying, and if you keep making your payments over 30 years, then eventually the debt goes away because you're paying a little bit of the debt every month along with the interest payment. Same thing with a bond, for a mining company. So we've created this bond concept. It's really not that different from a conventional bond, except it's denominated in ounces,
Hmm.
and the investor puts in, this is accredited investors only. There is that restriction, but and the leases are not. But there's that restriction. But you put in whatever, let's say 50 ounces into the bond. You have a contract for the return of 50 ounces plus the interest of whatever the interest rate might be. And the interest is simple interest. So on a lease, if it's 3% interest, which is the rate right now, and you put in 100 ounces, you get 103 ounces at the end of the year. So it's solving a finance need plus a hedging need for the borrower or the lessee, and it's solving the need for the investor to get a return. I mean, if the theory is that gold is money, and for anybody who knows my work knows that I am a radical in holding that gold is money and the dollar is as credit of a particular kind of credit. It's irredeemable credit, but it's credit. There is a need to get interest or a yield or return on savings, um, and this is ticking that box.
So going back to gold leases, and again, I'm just going to put myself in investors' shoes. So I'm listening to this podcast. Let's just say I've got 10 ounces of gold. I've got 10 Krugerrands or whatever, for example, and I live in the UK. So I come across monetary metals, I come across gold leasing. I like the idea of being able to get a return. I love the fact that returns in ounces, by the way. So that was one of the key points I wanted you to say as well. So I'm sat there. I'm a regular person. I've got 10 ounces of gold. Um, how do I then go about? Finding out more information or working with monetary metals in order to start, generating a return on that gold? How would I do that? Is it open to people from around the world, or is it just US
Yeah, yeah,
clients?
absolutely. So come to our website, which is monetary-metals.com. There's all kinds of information about it, and videos you can click on, all kinds of stuff. And then you can call us by phone. You can send us a web form, tell us a little bit about yourself and your goals and how much gold you're thinking about, and all that. And we have a relationship management team that will reach out to you, or you can call us directly, and we work out all the logistics of, okay, what kind of gold do you have. Now, most of our clients send us the currency by wire. They'll send whatever, $30,000 and just buy gold. That's 80% of it is that.
Mhm.
But we absolutely do support. Okay, you have 10 crew grants, fine. Where are they? And we will help work out the logistics of the easiest way to transfer those over to get them into the program.
Fair enough. And I think the other key point that you mentioned earlier on was that obviously nothing in the world is risk free. So again, I'm just putting myself in the regular investor's head. Uh, if I went ahead and worked with yourself, then as an investor, then what would the risks be? Would it be a sharp drop in the value of the gold? Would it be an issue with the company at the other end? If you can highlight, some reality, that would be fantastic.
We, as a matter of both ideology and just sort of simple mechanical nature of the way this works, the account statements are denominated in ounces. So the price per se isn't really a risk that we reckon with. Um, if you have 10 ounces and then you're in, it's a third of a year, so you have one more ounce, I'm sorry, 1.1 ounces, excuse me,
Mhm.
for a third of a year. Your account statements like you have 10.1 ounces. Yes, we do print on the margin and smaller print. Okay, that's worth this many dollars, which can go up and down. We don't really encourage people and say buy gold because it's going to go up. We don't really get particularly upset if it goes down because it's just the inverse. When you say gold's going up, gold is not going anywhere. Gold's the lighthouse on the rock. It's the ship that you're measuring it from. You're standing on the deck of the ship, which is slowly sinking, and it's in a storm where the waves are going up and down by 10, 20 meters. And you're like, why is that lighthouse going up and down and mostly up? The lighthouse isn't going anywhere. It's your ship deck that's,
Mhm.
going down and up and mostly down. So anyway, we don't really regard that as a risk per se. I mean, everyone needs to understand that if you need you have $10,000 and you need your $10,000 back in 6 months because you have a tax bill you have to pay or something, you probably shouldn't be buying gold, let alone putting the gold into a 1 year lease contract. You
Mhm.
probably shouldn't be risking it on anything that can go up or down in dollar terms. But if this is long term, savings and you don't have a particular need for it, then we do think this makes sense. We do think this is um, product that fits. So what are the risks? The risk fundamentally is what if the gold goes away and it's not covered by insurance? And so that could be depending on the lease, and we disclose the risks for each lease. But what if, in some cases, it's not insured? The owner of the company, the owner of the lessee, that is, steals the gold, tucks it under his arm, goes to the airport, and flies to a non-extradition country. That would be really bad if that happened. Um, what if, usually insurance policies exclude terrorism, biological, radiological, war. If we were to lease gold to, a jewelry company in Ukraine and the Russian tanks flatten the town, you're probably
Mm.
not getting your gold back, and there's probably not insurance that's going to cover that. Now, we didn't make that mistake. We try to be fairly careful about our geopolitical analysis. We try to have a more sophisticated understanding. If there's any question, any real question, I'm a big fan of. There's a kind of a mediocre movie with Robert De Niro in it called Ronin, and I wouldn't recommend watching the movie, but there's one great line. So he plays an American character in Europe of questionable background, to say the least, and he's kind of hiding out with this criminal gang, I think in France, if I recall. And another gang propositions that gang to do this deal where this gang had drugs, the other gang was going to buy it, and so they say, okay, bring your car to park it under this bridge abutment at 3 in the morning. Everybody out, no guns. Open the doors, the trunk, the hood, everything, and have the stuff in the trunk, and we'll bring the bag of cash. And he says in that Robert De Niro voice, "Don't do it. It's a trap." Anyway, they do it, and it turns out it is a trap, and then they get shot up. And, the survivors are jumping back into the car, and doors and hoods and, being ripped off in the car chase to get back to their hidey hole. And the gang leader says to Robert De Niro, "How did you know? How did you know it was a trap?" And he says in that Robert De Niro way, "A little boy once told me, if there's any doubt, there's no doubt." So we try to use that principle, if you look at a place like Ukraine, say, okay, well, doesn't make sense. But those are the risks. What if there's fraud? And in some cases, the fraud is covered by insurance, and we'll document that. If there's fraud or embezzlement or something like that, or just outright theft. Um, but in other cases, it's not. We document that. And we talk about what we do in terms of due diligence. How do we know these people? How long have they been in business? We're not dealing with startups that are, potentially fly by night. These are
Mm.
usually businesses that have been around for many years or decades or third generation, family or whatever. But, these things could happen. And, there is that risk.
And I appreciate you going through that, Keith. So I always like to cover every angle as well on this on that. I think that's probably a great place to wrap up, to be honest. Just to summarize what we've gone through. So we've spoken about uh, Trump's potential tariffs and the impact that could or could not have potentially on the markets. We've also looked at gold leasing and have spoken about gold bonding as well. The big caveat, I think, as we mentioned earlier, is we're recording this before the Fed meeting on the 29th of January. This podcast is out on the 30th. So, of course, depending on what's happened there could be a little bit of increased volatility between this recording and that going out. And if I'm right in saying, Keith, if people want to follow you, get in touch with you, it's monetary-metals.com. And then you're also on X at Real Keith Weiner. Is that correct?
Yeah, and that's KEITHWEI. There are, and I emphasize that because there are these, scammers or whatever you call them that take a name that is confusingly similar, misspell your name in some way or another, and to try to siphon off followers, and then and they take my picture and they retweet some of my or copy and repaste my tweets, and it's always a losing battle. It's an arms race. You're always trying to shut them down, and they're always restarting them, and they have a lot more time and energy for that than I do. So yeah, be wary of that. But the real guy, I've got probably a lot more followers than most of those, spammers would have.
Uh, yes, I would imagine so, and I will put links to Monetary Metals yourself on X as well. I'll put all of the links in the show notes and also the post on Substack, contrariancapitalist.substack.com. Keith, that's been very eye-opening. I really appreciate your time. Thank you very much, and look forward to hopefully catching up towards the end of 2025 to see what the lay of the land is, if that's okay with you.
Absolutely. Thanks so much for having me, Robert.